Hi, I'm John Illig with Brokers Alliance here in Fountain Hills, Arizona. In this segment of Guaranteed Annuities, the basics and beyond, we're going to learn a bit about the different components that make up an indexed interest crediting formula and how they work together. Let's take a look. Now, the concept is pretty simple behind indexed interest. The idea is that when the stock index rises, a portion of that rise is credited as interest to the account value, whether that's a life insurance contract or an indexed annuity, and locked in at that time. When the stock index declines, there's no loss to the account value, and this is the commonly used phrase for this: upside potential with downside protection. Well, this index gain or loss, and of course the credited interest as a result of it, is determined by something that's referred to as a crediting formula. Again, typically the term crediting strategy is used in consumer literature. Now, when we look at these crediting formulas, there are certain components that we have to understand how they work, not only independently, but more importantly, how they work together. And the three that we're really going to take a look at are the crediting period, the participation rate, and the cap or the spread, again, depending upon what the specific type of formula is. And the combination of these components is what's going to determine interest crediting. So let's begin with the crediting period. It's simply how often the indexed interest is calculated and credited to the account value. Now, that typically begins at the contract issue or an anniversary date of the contract. And of course is going to go to the next contract anniversary or whatever period of time they're using for that crediting period. Now, a crediting period is typically, in most contracts we see out there, somewhere 1 year to as much as 5 years. So we have 1 year crediting period. Some products have 2 year, 3 year, 5 years. The crediting period can be as long as the carrier who's designing the product wants it to be, but again, most typically we're going to see somewhere between 1 and 5 years. Now, one of the reasons this matters is because interest crediting in an indexed annuity, for example, or an indexed life product, interest crediting only occurs at the end of the crediting period, again, some contract anniversary. So therefore, any withdrawals or required minimum distributions that are taken from the product in the middle during that crediting period are not going to get credited with interest at the end. So for this reason, 1 year crediting is the most common used. It's not necessarily better, it's just more popular, certainly with consumers and with many agents, for a couple of reasons. First of all, because we're getting interest crediting every year, assuming the index rises, of course, but also because for people who are using their products for some form of income withdrawals, again, we don't want to go too long without interest being credited. So again, typically 1 to 5 years is the crediting period, with 1 year being the most common, but again, anything can be designed out there, and certainly has been. The next common component is called the participation rate. This is the component of indexed interest formulas that, for a lot of folks, is kind of the hardest to get your arms around. And the participation rate is simply the percentage of the gain in the stock index that is eligible for participation in the interest crediting formula. Well, that's a whole mouthful, so it's kind of easier to take a look at a simple example. So let's assume that in a given crediting period, the market index rose by 10%. Well, if I have a 100% participation rate, then what that means is 100% of that 10% index gain is going to be eligible for interest calculation. So again, very, very simple in that sense. 100% of the 10% is 10%. If my participation rate is 75%, then what that means is 75% of the 10% gain is going to be eligible for participating in the rest of the crediting formula. So in that case, if the market did 10% gain, but my participation rate was 75%, then 7.5% or 75% of 10% is going to be eligible for that interest calculation. And again, taking that same concept there, if my participation rate is 50%, then a 10% market gain, 5% would be eligible for interest calculation. Again, 50% of the gain, in this case, 50% of 10%. Now, the majority of fixed indexed annuities and fixed index life policies use a 100% participation rate, typically with a cap. But they might also use a spread instead of a cap. We'll look at those next. If a product uses less than a 100% participation rate, in the example on the screen of 50%, they typically do not use a cap. but they might use a spread. So, again, looking at our example here, a 10% market gain and a 50% participation rate means that 5% of that gain is eligible for interest calculation. The final component we want to take a look at is the cap or the spread. The crediting formula will typically include either a cap or a spread, but not both. Let's take a look at it. We'll start with the cap. Pretty simple concept. The cap is simply the maximum percentage gain eligible for interest crediting. That can be applied monthly, annually, or over, at the end of several years. Again, just depending on, what the crediting period is that's being used for the particular strategy. But let's keep it simple. Let's just say we have a 5.5% cap. Well, the cap is simply the maximum that can be credited. So if our index gains 3% as an example, and we have a 5.5% cap, then the client's account value is going to be credited with that full 3%. Again, I'm assuming a 100% participation rate here. Now, if the market does 5.5% and we have a 5.5% cap, then clearly the crediting is going to be 5.5%. As we can see, the cap basically says this: you get everything that the market returns up to the cap. So it returns over the cap, in this example 6%. If my cap is 5.5, I'm only going to get credited 5.5. So cap, pretty simple concept here. It simply, again, is the max that the account value can be credited during any crediting period, and again, most commonly 1 year. Now the spread is different. A spread, if a product uses a spread, is a percentage that's going to be deducted from the index gain to determine interest crediting. Again, just like a cap, that can be applied annually, monthly, over a period of several years, again, just depending upon the crediting period that's being used. So again, to take a simple example, let's just assume that we have a product or a strategy that uses a 1% spread. Now let's assume we have a 100% participation rate. So if the index gains 3% and I have a 1% spread, well, I'm going to deduct 1% from that 3% gain, so the interest crediting would be 2. And again, we can just take this example again. If the index returned 5.5%, but my spread is 1%, then the index crediting will be 4.5. And again, 6% index gain on a 1% spread, the account value is credited with 5. So again, typically we'll see within an index strategy either a cap or a spread, but very rarely will we see both. And part of the reason for that is that these crediting formulas, they're used to control potential crediting that could be too high to support with interest rates. For example, a market index could return 20% over the course of a year, and has been known to. So the function of the participation rate and the cap or the spread, some combination of those two, is used by the insurance carrier in a fairly complex kind of actuarial projection formula to control potential crediting. So the main tools for this interest crediting control, if you will, are the participation rate and the cap or a spread. And depending how they want to put these things together, we can accomplish the exact same potential interest credit by putting different combinations of these together. And that's what you commonly see when you're comparing perhaps one product to another or something like that. So let's look at an example. Let's just assume that based upon some actuarial and financial projections, that interest rates can support a maximum of a 5% interest credit. We'll assume over a 1-year crediting period. And let's say the market index returns 20. Well, again, interest rates can't support that 20% return. So we're going to see how you can now put these different combinations of participation rate and a cap or a spread to accomplish exactly the same thing. If the index formula uses a 100% participation rate and a 5% annual cap, and the market returns 20, well, we get up to the cap, right? So we're going to get credited with 5% interest. But I can create that same potential interest crediting by using a 25% participation rate and no cap, and I'm going to get exactly the same end result if the market returns 20%. Here's another example of that. If the market returns 20 and my interest rates can support 5%, I can instead say, oh, well, I could do a 30% participation rate and a 1% spread, and I'm still going to end up in all three scenarios with the exact same credited interest. Now, that doesn't mean that 100% participation rate with a cap versus say a 30% participation with a spread, that one is definitely better than the other. It's just a different way of getting to the same endpoint. However, 100% participation rates with caps are very common because for most consumers, it's a little easier to explain to them. Okay, a cap is very easy to understand versus a, say a 25% participation rate. But again, we see all of these available in the marketplace, and all of them can be very good strategies. It just depends upon how it's being put together. And again, in any given probably short period of time, one might outperform another depending upon what the market does. Now, interest rates. This throws people sometimes because, again, you could say to yourself, I thought interest earnings are based upon the performance of the stock index. Well, of course they are. That's a major component of this. But when we look at what is affecting what we call cap rates or participation rates, or the level of spreads, high or low, current interest rate environment is the primary factor that affects the level of these caps, or again, participation rates and spreads. The other factor in that is projected market volatility. And without getting into, again, very complex sort of actuarial formulas on this, we can look at this, and particularly for the benefit of our clients, and we can take this fairly simply. If interest rates go up, we tend to see caps increase, or if the product is using a spread, the spread will tend to decrease. Conversely, if interest rates go down, we seem to see cap rates decrease, or a spread, if it's using a spread, that spread will get larger. So again, the cap and the spread are actually accomplishing the exact same thing within the product, just kind of in a different way. So the major driver of cap rates or participation rates or spreads is the interest rate environment. But index volatility also plays a role. And of course, index volatility simply means how predictable up or down over a year or more is the index. So as the index tends to get more volatile or more unpredictable, we tend to see caps go down or spreads increase. And when the indexes are less volatile, i.e. more predictable, then we seem to see higher caps and spreads decrease. And the truth is that when a carrier is setting its cap rates, or again its spread rates or its participation rates, it's really the combination of these two in a pretty complex actuarial assessment looking into the future that they're actually using to set these different rates. But these are the main things that tend to affect that. So again, we could be in a very high interest rate environment, which would give us, in theory anyway, very high caps. But if the index is really volatile and difficult to predict, well, in that case, that could bring those caps back down because the cost of supporting the extra indexed interest by call options gets higher. The other thing that can affect what a particular participation rate or cap or spread is just simply the length of the crediting period. Again, crediting periods are typically 1 year, but they can be 2 or even 5 years or even 10 years. So as a general rule, if the formula uses a cap or a spread with 100% participation rate, we can say the longer the crediting period, the higher that cap's going to be, or the lower the spread will be. For those formulas that use only a participation rate of less than 100%, well, again, the longer the crediting period, what we'll typically see is the higher that participation rate. And again, if it's a participation rate product with a spread, then again, the lower the spread, the longer. And that only makes sense because it's a longer time that the client's money is working. So again, we'll have a higher potential interest crediting. So when we look at this, and when we as agents are evaluating and explaining to our clients how these products work, the main things we have to understand are, again, the crediting period, the participation rate, and the cap or the spread, and how the interrelationship of these three components determines potential interest crediting. So I hope you found this to be of value. If you have not already, you might want to take a look at the rest of the indexed interest training videos. Of course, today we were talking about the components of indexed interest formulas. We have a video on the stock market indexes and kind of how they work. And of course, as you can see at the bottom, you might want to take a look at how the math works on the 4 most commonly used indexed interest strategies. I hope you found this video to be of interest and you have a better understanding now of how indexed interest strategies are constructed and what the different parts do. As always, here at Brokers Alliance, we look forward to working with you, and so give us a call and get a hold of the annuity support team, and we'll answer any additional questions you might have. Thanks.